Good afternoon, viewers. This is episode 4 of the Slarskey LLC video series on specialty finance and litigation funding. In this series, we explore hot topics in the area of legal funding and related asset classes. Today's episode focuses on the perspective of institutional investors and credit investors, specifically on litigation funding. My name is Evan Freed. I'm a partner here at Slarskey LLC. Slarskey is a New York-based litigation boutique. We've had a footprint in the litigation finance space for over 15 years. Among other areas of dispute resolution that we focus on, we wind up handling a good amount of investment disputes involving specialty finance, as well as legal ethical issues, fee disputes, and the like, which also implicate litigation funding. Today's episode is all about the financiers. So we're lucky today to have two non-lawyers on the episode. And two guys that have had footprints in the space for many, many years and are true veterans. Blum from Flexpoint Ford and Josh Meltzer from Finitive. Ben and Josh, why don't you give a quick introduction on yourselves?
Sure. Thanks, Evan. Pleasure to be here. Benjamin Blum, a managing director at Flexpoint Ford. Flexpoint's an investment firm founded in 2005 with a focus on financial services and healthcare private equity and asset-oriented investments. We're currently investing out of our fifth private equity fund and our second asset opportunity fund. Within our asset opportunity strategy, we invest across a range of asset classes and transaction structures, but with a focus on creating downside protected investments, many of which are uncorrelated to broader macroeconomic trends. It's within our asset strategy that we've been active in the litigation finance space. I don't consider Flexpoint to be a litigation funder, but rather we're a capital solutions provider to the litigation finance space. In other words, we'll typically partner with a litigation funder to help finance their business or invest in diversified portfolios of assets that they originate.
Hi, everybody. This is Josh Meltzer. I'm the managing director of the intellectual property finance group at Finitive. Finitive is a 5-6-year-old company based in Manhattan, and we have a unique business model. We originate, structure, and co-invest in specialty finance opportunities alongside our network of investor partners. We're very active in the intellectual property space. We focus on situations where we can introduce novel deal structures, where we can streamline the process and pull friction out of the transaction closing process, to potentially expand the market and introduce new capital sources. So happy to be here. Appreciate the chance to chat up with everybody.
Awesome. Well, it's good to see both of you. Ben, why don't we kick it off with you? I mean, Flexpoint is multi-strat, right? You know, you have your private equity opportunities, and then the asset fund, which is really more focused on credit. You know, you are our credit expert on this. You know, why don't you walk the viewers through, you know, agnostic across any asset class, what as a credit investor are you looking for? What are you weighing in determining whether you know, the type of opportunity is something for Flexpoint or for another credit opportunity fund?
Yeah, so certainly within our asset opportunity fund, there are three general features that apply, across a range of asset classes that, help us determine whether this is an inappropriate, credit product or not. And one is cash flow. So you can imagine middle market corporate lending, an operating business that generates EBITDA and free cash flow that's available to service debt. So that's certainly one area, cash flow. Second would be asset coverage, which could take the form of lending against a pool of loans, so a loan on loan, or a loan on an asset like a piece of real estate, for example. And then the third are structural features. So, what structural features in terms of deal structure and so on are available to, create a credit-like profile. So, an example of, an investment that we made, we financed a number of specialty chemical tankers. So, ships that are carrying commodities around the world. And you may look at that and say, well, that's an asset-backed loan. You're lending against a vessel. It's an asset. You can see it, feel it, touch it. And you're lending at some LTV to the value of the vessel. And well, that's certainly true. And that was a component of our underwrite. We largely made a conservative assumption that the vessel would be worth scrap value. And the crux of the underwrite was really getting conviction around the thesis that the cash flow that the vessels could generate, especially in the near term, would be robust enough to support the investment. And we did a lot of work around the supply demand dynamics in the space and gain conviction in that thesis, and then use structural features to make sure that that near-term cash flow was going to delever our investment, such that we weren't taking that much risk with respect to the ultimate value of the asset. So that's an example of investment that might look like an asset-based investment, and it is, but it was really for us a cash flow and a structural features um, underwrite, and that's really our approach across the board. Especially given that we have the ability to invest across the capital stack, and as Josh certainly was alluding to, using the flexibility of that capital to create transaction structures that are attractive to us, but importantly also solve a problem or help meet the need of our partner or counterparty.
Yeah, I think one of the interesting aspects of this conversation is we find ourselves at a point where folks like Ben and others are saying, how do those credit type features and structural capabilities, how can we expand the footprint? And are there adjacent areas, or potentially not adjacent areas, but interesting areas where that credit mindset and the opportunity to bring credit into those spaces can create new value for everybody involved?
Yeah, I mean, look, we've certainly come a long way. You see even individual deals being split between, equity and debt, to allow all types of investors to participate. But let's go back to like the origins of the space and talk a little bit about how the space has evolved. If we dial it back some 5, 10, 15 years, what was the profile of, the typical institutional investor participating in litigation funding? Was it equity? Was it debt? Was it a little bit of both?
Yeah, I mean, I can jump in. I would say it's an interesting question that arose at the origins of litigation funding in the U.S., and it still exists to this day to a large degree. I actually look back at the original press release when the first kind of two commercial litigation funders were spun out of Credit Suisse in around 2012, and some of it was related to conflicts and they wanted to be independent. Some of it was related to uncertainty around whether this was debt or equity. It didn't fit naturally
Right.
into a certain segment of the bank. And I think as we look at the evolution of litigation funding and the growth of litigation funding, I think we're seeing that play out now, which is historically what I would kind of generically categorize most of the thinking and the structures as more equity oriented. You kind of more analogous. I guess the simplest example would be funding a single case with a non-recourse investment where you're sharing the recovery if there is one. That's kind of the most analogous to a venture capital firm kind of funding an entrepreneur with a business plan, right? But I think some of the things we're going to talk about today are much more credit-like, and they have unique features and offer unique opportunities. But I think it's pretty clear that version 1.0 of the litigation funding market was really equity oriented in the way the deals were structured and the way they were conceived.
Yeah, I think that's right, Josh. It's an interesting observation. I think in part, as you think about the single case funding market, perhaps at the origin, you're almost synthetically creating a contingency fee
Right.
arrangement, which
Exactly.
would typically be a percent of proceeds or a multiple
Exactly.
on time. And I think to your point, even within that space, as the markets evolve, people are thinking more about IRR, especially if you're looking
Exactly.
at a case that could take a really long time. Well, making 2 times your money sounds really good. If it takes, more than 10 years, it's
Exactly.
less good on an IRR basis. And then, obviously as the space has grown and diversification and tools to diversify have come in, it's really, created an investable asset class for, more than, the folks that, perhaps were there, at the origin.
Yeah. Well, sorry, Josh, go ahead.
No, go ahead, please. I think that's right.
Well, I'd say, let's focus there. Let's, I guess fast forward 10 or 15 years. What are what are the individual opportunities that in and of themselves kind of look like credit, even on the micro level of the individual claim, and then on the macro level, how can you take what's otherwise an equity investment, whether it's a pool of highly volatile contingency fees that have those equity like features, and how do you transform that into a credit opportunity for the right investor?
So Josh,
Ben,
maybe I'll start on law firm loans, and you
great.
can expand from there. I mean, it's interesting, and Evan, I know you and I have spoken a lot about this over the years. If you think about a law firm loan, at its face, it seems like an obvious credit product, but there's a range, right? And if you're for example, a personal injury law firm that handles a lot of motor vehicle cases, there may be some cases that are complex and take a long time and ultimately end up going in front of a jury where the potential damages are quite high. But a large number of those cases are, likely to settle within months and not years. And so if you're a personal injury firm handling a lot of those cases, it's likely you have, a lot of real cash flow coming in. And if you're looking at that from a credit perspective and a lender perspective, you can certainly look at the historical revenue and expenses of the business, and you can look at the current case inventory and make some projections about what's going to convert to cash when, based on historical settlement rates and so on. And you can approach it more as I'm lending to a business that happens to be a law firm, and that feels like
Exactly.
a credit product. On the other end of the spectrum, again within law firm lending, to use an extreme example, if you have a mass tort marketing firm that has case inventory in early and mid stage mass torts, if you were to look at that from I'm going to underwrite traditional underwrite of the business, there may be no revenue and no cash flow. So kind of going back to the first point around what we look for in credit, is there cash flow? No, not in that instance. Well, is there asset value? And I think it's certainly a fair argument to say, well, these retainer agreements, these contingency fee agreements, they constitute an asset with value. And, we're often shown deals at really low LTVs, putting a value on that contingency fee inventory, if you will. And, as you dig into it, though, especially these are earlier stage matters, the V is squishy, and there's a range. It could be worth zero, it could be worth something, it could be
Right.
worth a lot. It depends on how the tort does with fallout rates and so on. And so we look at something like that, and the V has perhaps more of an equity profile than a debt profile.
Right.
And then you can certainly try to layer in structural features, but to me at least, some of those opportunities feel more suited for equity, even if they're being presented in debt form, because it's a note agreement and it's got an interest
Right.
rate. But with the interest rate picking and getting added to the loan balance, that LTV over time, even if the asset value doesn't change or your perception of the asset value doesn't change, every year you're adding PIK interest to your loan balance, you're eroding your over collateralization or your downside protection. And so, we look at those and we view those more as equity like investments. And Evan, perhaps a topic for a different chat, but I think increasingly, folks looking at the ABS structures and so
Yeah.
on, ways for non-lawyers to own equity in law firms, is the market kind of recognizing that perhaps that's not as easy of a debt product as it is an equity product.
Yeah, I agree with that. And I would just add that I think there's a pretty logical evolution for these products within litigation funding. It does tend to start simple, with, single case funding, and then, portfolio funding emerges at the law firm level because it offers diversification. And then I think once those start to get, out in the market, I think people realize there's hybrid opportunities that kind of fall between. Then you want to combine the best aspects of portfolio funding with the best aspects of single case funding, and that creates a next wave of kind of innovation or creativity. And I think that's where we are now. I think we're kind of, you're starting to see more sophisticated funding models, more sophisticated business models for funders. And it's things, frankly, it's things that it's things that people in private credit and other more established asset classes just take for granted as having been there for decades. But I think we're now at almost at a tipping point or an exciting entry point for litigation funding where we can start to talk about risk mitigation and portfolio diversification and, like I said, concepts that are, documented to work and well understood in other markets. And they're now making their way into litigation funding, which I think historically has obviously understandably been much more kind of legal law firm centric or legally oriented in its mindset.
Yeah.
And sorry, go ahead, Evan.
No, go ahead.
For us as as an investor in the space with a downside protection focus, investing in a single binary outcome, even if it's very well priced, is a difficult proposition. So the ability to make that type of profile investable for us at least comes down to structural features, which primary of which is diversification and cross collateralization and pooling of these risks and
Yep.
Managing them such that no one outcome will drive the outcome of our investment on a pool basis. And other structural features increasingly with insurance moving into the market and the ability to, as Evan, you mentioned, to tranche deals into different risk tolerances. That's where we really get interested, given our focus on managing the downside.
Yeah, I mean, look, there's a difference here. I mean, on one, we talked about the difference between a commercial case and a personal injury case. A law firm that has 5 intellectual property cases, you can call that credit, or you can call that credit risk, but it still might be 5 highly risky venture capital like opportunities, which sure, you could take a square peg and put it into a round hole, but it's, let's call it what it is. It's still a risky opportunity. And there's a fundamental difference between that and, for example, a personal injury firm that has many things that tend to click and spit off cash flow. But you raise an interesting point. You also have the issue here, even with the personal injury firm of the traditional prohibitions on fee splitting, right? And one thing that you've seen historically, at least from the lawyer's perspective, is taking opportunities that are fairly risky and that smell a lot like equity and converting those into debt-like structures with rates of return as opposed to percentage of the upside in order to get around the fee splitting rules. But I mean, you did touch on the ABS structure, the alternative business structure. How are the credit investors, how is the investor market at large looking at these? Is this a live investment opportunity, or is this a little bit theoretical at this point?
Yeah, at least for us, it's theoretical at this point. We're monitoring with keen interest. I think I think that's where the puck is going long term, and we're probably in the early innings of an evolution, in terms of how law firms can be structured and owned. But it feels like we're somewhere on that journey, and we're watching it closely, but it's not created direct investment opportunities for us to date.
Evan, can I just add a quick note coming off of the conversation we just had? I think diversification is a word that gets used a lot, and there's a lot to it as well. And there's multiple layers of diversification, and you can easily and thinking you're fully diversified and actually being effectively diversified can often be different. And I just want to give a quick example because, like I said, litigation funding started out with single case funding, and then there was a big move towards law firm portfolio funding. There were several high profile deals that were announced. But by definition, a law firm portfolio deal is not diversified by law firm.
Right.
Right. Law firms fail. Law firms run into difficulties. So now I think we're at a point where the question is how do you create more nuanced structures that are very attractive for the law firms, for their clients, and create really unique risk return profiles for investors. and the introduction of insurance, the introduction of kind of private credit tools and frameworks being applied to these assets, I think is a huge development. And it's a promising one, but it's ultimately, I think, a necessary one if the market's going to grow. Because I think in the prior in the first 5 to 7 to 10 years of its life, I think the market was going to achieve a certain scale, but absent this next wave, I think it would have stayed at that scale. And because investors like Ben and others are coming in to innovate, I think you're going to see the market grow because there's going to be more of an ability to deploy meaningful capital into these deals.
Yeah, and listen, I think certainly you look at something like a loan against a judgment preservation policy where an insurer has, written insurance against, a judgment that's on appeal. If you look at kind of the range of investors, in the asset class, you obviously have, the, litigation, funders that are, in the market, every day funding individual cases, or portfolios. And then you have, more of the kind of private equity or multi-strat, hedge funds that, are looking at this as, in terms of how it fits into, a broader portfolio. And something like a loan against an insurance policy, I mean, certainly I see how that appeals to more credit-oriented funds that can look at the insurance policy, not have to think too much about the underlying litigation, assuming the policy is sound. And yes, you're taking some duration risk and you're getting, paid for the duration risk and, the policy and so on, but it's less of a litigation underwrite. It's more of a credit product. And then that, investor is going to look at, well, how much return am I getting here? Because I have some duration risk and maybe I have to pick my interest, versus, other asset classes where I'm getting current pay interest. Maybe I have similar or worse credit risk than the insurance company. And what's the relative value between those two? And so I do think you're right, Josh, as the market evolves and insurers become, more active, it opens up, capital opportunities for folks that, otherwise, wouldn't be able to access the
Access
space.
this market.
Yeah.
Yeah. I think that's right.